can export goods which are physical, which are visible. So these balance of trade takes into account only those transactions arising out of the exports and imports of the visible items. It does not consider the exchange of invisible items such as the services rendered by insurance, banking, shipping, payment of interest, dividend or expenditure by tourists. These are all invisible items. But the balance of trade, it records the transactions arising out of the exports and imports of the visible items. Visible items means physical goods. So, therefore, balance of trade is nothing but the difference between the value of goods exported and imported. Here, it is noted that both goods and services are counted for exports and imports, as a result of which a nation has balance of trade for goods and balance of trade for services. If the balance of payments is a narrow term, balance of trade is a broader term. Balance of payments and balance of trade, both are different. The balance of trade includes only visible items, but the balance of payments includes all transactions related to visible, invisible, and capital transfers between various countries in the world. So friends, the balance of payments is different from balance of trade. BOP and BOT. Balance of trade includes only visible items, only goods or physical goods. Balance of payments includes all the transactions related to visible, invisible, and capital transfers. So, BOP consists of current account, capital account, but BOT consists of BOT is equal net earnings on export minus net payment for imports. Here BOT having the differences between the net earnings on exports and net payment for imports. This difference is known as balance of trade, but the balance of payment consists of two accounts, current account and capital account. The main factors which affects the balance of payment are conditions of foreign lenders, economic policy of government, all the factors of BOT, prices of goods manufactured at home. These are all the factors which affect the balance of payments. Whereas the main factors which affect the balance of trade are cost of production, availability of raw materials, and exchange rate. So anyway, a country's balance of trade is influenced by all the factors that affect international trade. So there is a difference between balance of trade and balance of payments. So this is the difference between balance of trade and payments, where as the balance of trade include only those transactions arising out of the exports and imports, only the visible items. So it does not cover the transfers of invisible items such as services rendered by shipping, insurance, banking, and others. Whereas balance of payments takes into account the exchange of both visible and invisible items. So, visible and invisible items transactions or account is known as current account items. Whereas the capital transformation between various countries, it is recorded in capital account. So, balance of payments consists of two accounts, current account and capital accounts. So, besides the current account and capital account, balance of payments also include unilateral payments account and official reserve account. So, this is the difference between BOT and BOT. These are the components of balance of payments. The transactions that are fell under balance of payments are recorded in standard double entry bookkeeping, under which each international transaction undertaken by the country will result in a credit or debit entry of equal size. So it is nothing but an account of all the transactions between the countries which are involved in international trade. The format of balance of payments given below shows the importance types of transactions that enter the balance of payments. They are current account, capital account, unilateral transfer account, and official reserve account. So, therefore, the components of balance of payments are four. Current account consists of two major items, namely merchandise exports and invisible exports and imports. Merchandise exports are nothing but visible exports and imports. We may have foreign relations and trade relations with other countries and other units of various countries. Then one country or one company of a country can export some goods and import some goods and visible items. These are all transactions of visible and invisible items are recorded in a statement, in a systematical statement that is known as current account. Whereas the capital account consists of short-term and long-term capital transactions. So the balance of payments of a country is a systematic record of all economic transactions between the residents of a country and the rest of the world. So these, it presents a classified record of all receipts on account of goods exported, services rendered, and capital received by residents and payments made by them on account of goods imported and services received from the capital transferred to non-residents or foreigners. So in this way, the transactions are recorded. They are known as balance of payments. So the balance of payment records all the transactions that create demand for and supply of a currency. This indicates demand supply equation of the currency. This can drive changes in exchange rate of the currency with other currencies. So we always compare the changes in exchange rate of Indian rupee with the international currency. And balance of payments may conform trend in economies, international trade, and exchange rate of the currency. This may also indicate the change or reversal in the trend. This may indicate policy shift of the monetary authority of the country. In our country, the monetary authority is Reserve Bank of India, Central Bank. So all economies have the cross-border economic transaction that involve transfer of funds from one nation to another. So the balance of payments is a statement or record of all monetary and economic transactions made between a country and the rest of the world within a defined period. A period of a year or a quarter. These records include transactions made by individuals, companies, and the government of a country with the rest of the world. Keeping a record of these transactions helps the country to monitor the flow of money and develop the policies that would help in building strong economy. The money coming in and the money going out should be balanced. But that does not happen in most cases. A country's balance of payments statement correctly indicates whether the country has a surplus or a deficit of funds. The balance of payments indicates surplus where a country's exports are more than its imports. It indicates deficit where a country's imports are more than exports. If the imports are more, there will be a deficit. If the exports are more, there will be a surplus in balance of payments. An account of all receipts and payments is termed as balance of payments. So according to Kindleberger, the balance of payments of a country is a systematic record of all transactions between the residents of a reporting country and the residents of foreign countries during a given period of time. In the exports, in exports, are the receipts from exports can be recorded as credits, and the payments for imports can be recorded as debits. In credit side, exports of goods, exports of services, interest, profits, dividends received, unilateral receipts, and foreign investments, short-term borrowings, medium long-term borrowings, and statistical discrepancies, changes in reserves. These are all recorded in credit side. But in payment side, imports of goods, we pay, a country pays for the imports of goods, imports of services, interest payments, profits and dividends paid, and unilateral payments to other countries, investments abroad, short-term lending and medium long-term lending, and changes in reserves. These are all items are recorded as debits in balance of payments. So there are 4 components are there: current account balance, capital account balance, and unilateral receipts. So current account balance, the current account includes exports of services, interest, profits, dividends, and unilateral receipts from abroad, and the import of services, interest, profits, dividends, and unilateral payments to the abroad. These are all recorded as current account. And capital account, in capital account, the receipts and payments on account of capital. So the capital account involves inflows and outflows relating to investments, short-term, medium-term, and long-term borrowings and lendings. All these are recorded as capital account. Official reserve assets account is there. Official reserves account shows the reserves which are held in the form of foreign currencies, usually in hard currencies like dollar, pound, gold, and special drawing rights. These reserves are analogous to an individual's holding of cash. So the current account consists of visible and invisible transactions, unilateral transfers, and income receipts and payments. Unilateral transfers are payments that are not factor payments. These are one-way transactions. For example, gifts, donations sent to the resident of a country by a non-resident relative. These are all known as unilateral transfers. So the income receipts and payments, these include factor payments and receipts. These are all generally rent on the property, interest on capital, profits and investments. They're recorded as income receipts and payments. And the factors, the determinants of balance of payments. The balance of payments can be affected on two accounts, current account and capital account. Factors affecting the current account are inflation, national income, government restrictions, exchange rates. If a country's inflation rate increases relative to the other countries with which it trades, its current account would be expected to decline. Due to higher prices at home, consumers and corporations within the country are most likely to purchase more goods and services overseas, while the country's exports to other countries will fall. So inflation lead to the decline in the current account. National income of a country rises if it is rise by a higher percentage than those of other nations. Its current account is expected to decline. And government restrictions also. If a country's government imposes a particular type of tax or tariffs on imported goods from foreign countries, the price of foreign goods to consumers effectively increases. An increase in prices of imported goods related to goods produced at domestic country will discourage imports and is expected to increase its current account balance. Exchange rate also, it also affects the current account of balance of payments. The value of a current country's currency regarding other currencies is called the exchange rate. So we know that the value of Indian rupee regarding other countries or international country is known as exchange rate. The changes in currencies exchange rate brought about by market forces and actions by nation government and government of other countries will influence a country's current account balance. Like this, some more factors which affect the capital account also. A country's government could impose a special tax on income account by local investors who invested in foreign markets. A tax would discourage people from investing abroad and could increase the country's capital account. Capital flows are also influenced by capital controls of various types. Interest rates also affect the capital flows. So the government policies and the tax policy and tariffs policy, inflation rate and interest rates, this all affect the capital account. So this leads to the imbalances in balance of payments. So trends in India's balance of payments, a country like India, which is on the path of development generally, experiences a deficit balance of payments situation. If there is a deficit, the government has to take some initiations and some policy initiations to correct the balance of payments, to attain the equilibrium in balance of payments. The equilibrium of balance of international payment is a statement that it takes into an account the debits and credits of a country on international account during a calendar year. When a country has unfavorable or adverse balance of payments, it is regarded as herald of disaster because the country, by having deficit in its balance of payments, either decreases or balances abroad or increases or foreign debts. When it has favorable credit balance, it is considered that the country is heading towards prosperity because by having surpluses, it either increases our foreign credits or reduces our foreign debits. There is no doubt that a study of country's balance of payment reveals much information about its economic position and development of the country. But when we are to see that a country is heading towards financial bankruptcy or higher standard of living, we are to examine the balance of payments of many years of that country. A persistent deficit in balance of payments on current account certainly leads to economic and financial bankruptcy. A continued favorable balance on current account is also disadvantageous because it creates difficulties for other countries. The credit country may utilize her surplus in advancing short or long-term loans to the debtor country. But if it gives no opportunity to debtor country to repay the loan by exporting more, then how can the loans be realized? So friends, here the balance of international payment is a summary account of total debits and credits of a country during a year. It includes both visible and invisible trading terms. Disequilibrium in the balance of payments can arise due to persistently one-sided movement of one or more than one trading terms. If, for instance, if the total value of goods exported exceeds the total value of goods imported over a given period, and this surplus is not offset by the debit balance on invisible item, the country will have favorable balance of payments. Disequilibrium in the balance arises when exports of a country fall short of imports because of decrease in production at home due to stiffer competition abroad or often appreciation in the currency and fall of purchasing power of the buyers in foreign market. When imports remain unaffected or increase, then the country will also face deficit in our balance on invisible items. The country will have disequilibrium in our balance of payments. Disequilibrium in our balance of payments can also arise over a given period of time due to excessive imports not equalized by exports of invisible items. If it is not offset by credit balance on visible items, the country will face disequilibrium in her balance of payments. So, when there is a disequilibrium in the balance of payments, the foreign trade or international trade is not favorable to that particular country. there are different kinds of disequilibrium in balance of payments. Many kinds of disequilibriums are there. They are cyclical disequilibrium, secular disequilibrium, structural disequilibrium, temporary disequilibrium, so these are the kinds of disequilibrium in balance of payments. Cyclical disequilibrium means it occurs on account of business cycles, depending upon the phases of trade cycles like prosperity, depression, boom. So the demand forces vary, causing changes in terms of trade as well as growth of trade, and accordingly a surplus or deficit will result in balance of payments. Cyclical disequilibrium occurs either because the patterns of business cycles in different countries follow different paths, because income elasticities of demand for inputs in different countries are different. This is known as cyclical disequilibrium in balance of payments. And one more kind is that secular disequilibrium. When an economy moves from one stage to another of development, a deep-rooted or long-seated disequilibrium takes place. It may be caused by a number of factors such as capital formation, technological change, growth of, and growth of population, growth of markets, changes in resources, and other reasons. These are all known as secular disequilibrium in balance of payments. One more kind of disequilibrium is structural disequilibrium. It emerges on account of structural changes in some sectors of the economy at home or abroad, which may alter the demand and supply relations of exports and imports or both. Actual deficit is measured by the extent of accommodating finance required to meet the deficit. So this is structural disequilibrium. And another one is temporary disequilibrium. It is also known as random or temporary type of factors which may lead to temporary disequilibrium in the balance of payments. For example, in India, floods, droughts, outbreak of war, these situations create and lead to temporary disequilibrium in balance of payments. Nowadays, we are looking at some countries like Pakistan. There is a temporary, due to various reasons, political or economic reasons, temporary imbalance is there. And one more kind of disequilibrium is short-term disequilibrium. The deficit may be of a short-term or a long-run nature. Sometimes any deficit may be met by inflow of short-term funds attracted by interest rate differentials. If circumstances which attracted capital are temporary, the capital may outflow and the deficit would appear. This is known as short-term disequilibrium. Another one is long-term disequilibrium. Any deficit may have to be viewed with a difference to their variations over a long period to eliminate random and seasonal fluctuations. And one more kind is the fundamental disequilibrium. When disequilibrium balance of payment continued for a long time and there is no expectation now or in the future that the new factors revealed in the balance of payments are likely to disappear. It is defined as a case of fundamental or permanent disequilibrium. So these are the various types of disequilibrium. Here, friends, if there is a disequilibrium in the balance of payments of a country, various measures are initiated by the country or other countries. This may correct the disequilibrium in balance of payments, and this may lead to correction the disequilibrium in balance of payments. There are a number of measures available for correcting balance of payments disequilibrium. They are two broad groups, namely automatic measures and deliberate measures. Automatic measures, according to the classical economists, any disequilibrium in balance of payment is corrected automatically without any corrective measures by the government. This method worked well under gold standard. Classicals, they felt that they suggested that not to interfere in the economic activities by the government. So, according to classicals, the disequilibrium in balance of payments is corrected automatically without intervention of the government. The balance of payment disequilibrium may be automatically corrected under the paper currency standard also. The theory of automatic correction is that if the market forces of demand and supply are allowed to have free plans in course of time, equilibrium will be automatically restored. As these conditions are not completely prevailing in the real world, such an automatic adjustment is not possible. Hence, when there is a deficit in balance of payment, government has to immediately act to introduce deliberate corrective measures. If there is not possible to correct the balance of payments with the automatic measures, the government has to intervene in the economic activities and it has to introduce some deliberate corrective measures to correct the disequilibrium in balance of payments. The deliberate measures, the various deliberate measures may be broadly grouped into monetary measures, trade measures, and miscellaneous measures. For example, monetary measures are monetary contractions, devaluation, exchange depreciation, and exchange control. Here, under monetary measures, contraction or expansion and devaluation of rupee and revaluation of rupee, and exchange control or exchange depreciation. And miscellaneous, under miscellaneous measures, foreign loans, incentives for foreign investment, tourism development, import substitution, incentive for foreign residences. So friends, the monetary contraction, under monetary contraction, the level of aggregate domestic demand, domestic price level, the demand for imports and exports may be influenced by contraction or expansion of money supply so that balance of payment disequilibrium may be corrected. Contraction of money supply is likely to reduce the purchasing power, thereby the aggregate demand. It is also likely to reduce domestic prices. The fall in domestic aggregate demand and domestic prices reduces the demand for imports. So these are the monetary measures. And deflation refers to that monetary policy under which the volume of currency is reduced. Consequently, prices, monetary income of the people are brought down. In India, the Reserve Bank contracts the volume of credit in the economy by using quantitative and qualitative methods of credit control. Increasing the bank rate, open market operations, making changes in CRR, cash reserve ratio, and SLR, and other measures also. And through the devaluation, what is devaluation is also part of monetary measures. Devaluation means the reduction of the official rate at which the currency is exchanged for another currency. Devaluation is that monetary measure under which government of a country lowers the value of its currency in terms of foreign currencies or international currency. Therefore, imports become dearer and exports cheaper. In this way, adverse BO is corrected. And exchange depreciation. If in the international sphere, rate of exchange is flexible, government need not restore to policy of devaluation. Under flexible rate of exchange, in case of adverse BOP, the rate of exchange goes down automatically. As a result, export will increase and adverse BOP will be corrected. And exchange control. Exchange control is a popular method employed in influence the balance of payment position of a country. Under exchange control, the government and the central bank assumes complete control over the foreign exchange reserves and endings of the country. The recipients of foreign exchange, like exports, are required to surrender foreign exchange for domestic currency. By virtue of its control over the use of foreign exchange, the government can control imports. So, due to these exchange control, we can correct the balance of payments, disequilibrium. And trade measures. Trade measures is also part of miscellaneous measures. In this, the different trade measures are import duties, export promotion, encouragement to foreign investment, attraction to foreign tourists, and social measures. In import duties, to discourage imports, their value is raised by levying in new import duties. In this way, imports become dearer, but their demand also goes down, and consequently adverse BOP will be corrected. Export promotion. By raising the export, adverse BOP will be corrected. All duties and restrictions should be withdrawn and export industries be given special concession and facilities. Intensively publicity and advertisement should be undertaken to increase the demand for domestic product in foreign countries. And encouragement to foreign investment. Investment of foreign capital in the country constitutes a credit item so as a favorable effect on the balance of payment position. And attraction to foreign tourists also is a measure. In order to attract tourists, the government has to develop recreation parks and entertainment programs and develop the tourist places. Foreign tourists bring along with them large amount of foreign currency, which serves the same purpose as the exports. And under social measures, the balance of payment can be corrected through the medium of social psychology. Awakening of Swadeshi spirit had adversely affected the balance of payments of British India. Presently, import of petrol and petroleum product is the major cause of adverse balance of payments of India. If social awareness is aroused the people to make economical use of petrol, it will have a salutary effect on the balance of payments. So these trade measures include export promotion measures and measures to reduce imports. Export may be encouraged by reducing and abolishing export duties, providing export subsidy, encouraging export production, export marketing by giving monetary, fiscal and physical and institutional incentives and facilities. Apart from other mentioned monetary and trade measures, there are a number of other miscellaneous measures like foreign loans, foreign loans and foreign investments, tourism development, effectivity for inward remittances and import substitution to correct the deficits in the balance of payments of the country. These are all other measures to correct the balance of payments. For example, India's balance of payments, when we talk about historical perspective of India's balance of payments, India's BOP evolved reflecting both the changes in our development paradigm and exogenous shocks from time to time. In the 66-year span, 1950, so in the 75-year span, for example, in 1950 and 52 to 2017-18, 6 events had a lasting impact on our BOP. In 1966, the rupee devaluation, the first and second oil shocks of 1973 and 1980, external payments crisis of 1991. Due to these external payments crisis, we had to implement liberalization, globalization, and privatization policies and macroeconomic stabilization policies in Indian economic system. The East Asian crisis of 1997 also have had effect on Indian economy. And Y2K event of 2000 and the global financial crisis of 2008. These are all the shocks to the Indian economic system. So, therefore, the India's balance of payment always under pressure and had huge deficits due to the high imports of food grains and capital goods and heavy external borrowings and its payment and poor exports. So these are the measures to correct the imbalances or disequilibrium in the balance of payment. So friends, today we have discussed the balance of payments and the causes for the disequilibrium in the balance of payments and the difference between balance of payments and balance of trade and the disequilibrium in the balance of payments, various kinds of balance of payments or various kinds of disequilibrium in the balance of payments and the corrective measures, the disequilibrium in balance of payments. So the balance of payments is a record of economic transactions of a country with the rest of the world. And it consists of various accounts, current account and capital account, importantly. The causes for disequilibrium differ from country to country and time to time within a country. The main causes for disequilibrium in balance of payments are economic, political, social in nature. For example, economic causes are developmental programs, demonstration effect, natural causes and cyclical fluctuations, income and inflation, deflation and globalization. And the social causes may include changes in taste and preferences due to the demonstration effect and population growth rates and rate of urbanization. And the political causes are political stability and instability in a country, war situations, and change in diplomatic policy and change in foreign trade policies. These are the main causes for disequilibrium in the balance of payments. With this, today we are ending this class. Okay, friends, by this we have completed the syllabus, whole syllabus in public finance. Okay, thank you very much, and I wish you all the best.
Thank you, sir. Sir, give some important questions for exam, sir.
Okay, Nana, you can go through the syllabus and old question papers which are available in the university website, and you can understand how they are making questions and posing questions for internal and external exams. Okay, Nana, thank you very much.